Hello, and thank you for joining today's webinar. My name's Evan, and I'll be your moderator for today's presentation. Before we start, I'd like to go over a couple of housekeeping items. The webcast is designed to be interactive, and the console can be completely customized. You can resize or move any windows that you have open. At the bottom of your console, there are multiple applications that you can control, including Q&A and Help. If you have questions, please submit them by clicking on the Q&A button. We will try to answer each at the end, but if we don't get to your question individually, we will follow up with you afterwards. If you're experiencing technical difficulties, please click on the Help icon to resolve common technical issues. Most of the time, simply refreshing your browser will solve any audio or visual issues you may be having. With that, I'd like to introduce Jason Maynard, Senior Vice President of Marketing and Strategy at NetSuite. Jason, the floor is yours.
Thank you, Evan, and good morning or afternoon, wherever you are, and welcome to our webinar on Roadmap to a Successful IPO, Part 1. Being Part 1, that means we're going to have other parts, and stay tuned, watch your email or Twitter or LinkedIn for some announcements on some of the other upcoming webinars and events in this series. We're dedicating a lot of interesting content and time and speakers to the concept of how do you go public, how do you prepare, both from a communications, financial, accounting, tax, all the elements that go into a successful IPO. But one of the things that we wanted to do with our first event in this series was bring on one of the smartest guys that in the business around how to prepare to go public. And I'm very pleased to have joining me Tim Dolan, Managing Partner of ICR. ICR is the leader in strategic communications for companies. And Tim will tell you a little bit about his business. But before I turn it over to Tim, I've known Tim for almost, 20 years. He's been at ICR since 2003. He's built out their technology practice. Before that, he was an analyst with Alex Brown and Deutsche Bank. He was literally a top-ranked analyst in almost every poll. So if you guys follow, you know what an EGOT is, Emmy, Grammy, Oscar, Tony. He literally was number one in all those things for Wall Street software analysts. So we have a true legend in the equity research Wall Street world on software companies. Tim's worked on over 100 IPOs during his time. He has seen everything, good, bad, ugly, what to do, what not to do. So we're really excited to have someone with such a wealth of experience joining us on the call today. Tim, with that, welcome and thank you very much for being part of this event.
Sure. Thanks for having me, Jason. I think that could be the first time I've been called a legend, so I appreciate that. And welcome to everybody on the webinar. As everybody may not be familiar with ICR, I thought I would give a quick background. As Jason kind of indicated, we're one of the largest and fastest growing advisory and strategic comms firms in the country. We're organized like an investment bank with 15 to 20 dedicated industry groups. And our services essentially span IPO advisory, investor relations, public relations, as well as digital and crisis communications. So I run the tech group, following, the career on Wall Street that Jason noted. And at ICR, we've helped to prepare more companies for the public markets compared to any firm. We've got the largest IR practice in the country, and, we have a large and rapidly growing corp comm or PR practice as well. And, there's no other firm that integrates all of these disciplines together in the manner that ICR does, which, we believe has been critical to our success. Jason also noted, we've worked on 100 IPO processes just within the technology group in the 15 years that I've been with the firm. And, during 2017, the tech group worked on 9 IPOs, including companies, just a few here like a MuleSoft, MongoDB, CarGurus, SailPoint, and others that were, mostly, I would say, in software as well as internet e-com. You can also see that, many of these IPOs performed, very well, which led to a few companies executing follow-on transactions when their lockup was about to expire. And, while I run the tech group for ICR, it is important to note that our firm has sector experts in almost every major industry. During 2017, the firm worked with domestic and international IPOs that spanned, sectors like consumer, retail, financial services to industrials, pharma, and biotech, among others. And if you look over the last 5 years or so, our firm's worked with over 15% of all companies to list in the U.S., irrespective of the sector that they're in. So with that background, let's move into the meat of the discussion. I had planned on walking through some metrics related to companies that IPO to provide a bit of a baseline for what is needed. Quick overview of the current state of the capital markets, why you should be thinking about both, IR and PR well in advance of the public offering, including, why financial communications are critical, post-IPO as well. And along the way, throughout and then, towards the end, I'll talk a bit about some real-world examples where companies have executed well, and in those situations where, we've seen companies that didn't do as well as what they should have, and, and the type of impact that can have. So why don't we start off, with the financial profile of IPO companies. And, a lot of times when companies start to think about when they'll be ready to IPO, we often get asked about how big they need to be in order to be attractive for public investors. And this is something that'll clearly differ by industry sector. So you always need to look at relevant transactions in your industry, over an extended period of time, ideally. But when we took a snapshot of software-related companies that went public in 2017 as a sample, the average was around 165 mil in revs on a trailing 12-month basis when you exclude Switch, which is more of a data center company that borders on being a REIT. You can also see that the average projected growth profile was 27%, on a go-forward basis. And I just keep in mind that's a street number, so you'd probably estimate the average internal, kind of targeted growth profile would be closer to 35% growth, for that class of companies. You'll also see that over half of the companies were losing money on an adjusted EBITDA basis, some meaningfully. There is only one company out of this class that was sub 100 million in revenue on a trailing basis that IPO'd during 2017, and that was actually a client of ours, which was Alteryx. But they're also one of the higher growth companies with actual growth of over 50% and projected growth of 40%. I'd say in general, there's been a trend of companies staying private longer and going public at larger scale than in years past. And I'd say, in many situations, this is because companies have raised significant private capital. A lot of times that scales at or above, IPO size deals in years past, and it's often been at fairly hefty valuations. So companies have needed to grow into the valuations for what they've raised publicly. But it is still quite possible for companies below 100 million revs to have very successful IPOs. And I would say, outside of Switch, again, the average enterprise value at pricing was about $1 billion for software companies in 2017. Though there were still some very successful IPOs that priced in a range of 600 to 800 mil, and there was a low end of just over 300 mil in enterprise value. But this was clearly the outlier in the group. That level is clearly possible, but it doesn't leave a lot of room for error, essentially. When we look at a broader sample size of companies, that were software related, again, from 2010 till the present time, you'll see that the median trailing revs during this time frame was actually under 100 million. And for IPOs that priced above the range, so the most successful IPOs, it was a bit larger at roughly 110 mil. but still relatively close. A few of the interesting points from the slide I would say is, the median offering size is largest for the IPOs that priced above the range, and the deal size was the smallest when they priced below the range. So, bigger is better to a degree. There's more demand for liquid stocks. The growth rates are the highest for the deals that priced above the range, and you can see that the growth rates are the lowest for the IPOs that struggled the most and priced below the range. Another interesting point is from a profitability perspective, the above the range IPOs were losing money, albeit on a narrower margin, when compared to within the range IPOs. But both of these categories compared to the below the range IPOs that were actually profitable. So being profitable in and of itself is not the primary driver of interest for investors in IPOs. Growth is the top priority. And you can see from a multiple perspective here, the highest growth companies, which are those that priced above the range, also priced at the highest multiples. You can also see that the higher growth companies also priced at the greatest IPO discount. So when you compare how much higher the stock price was the day after and 30 days after the IPO priced, and this is because the buy side, the investors are using much higher future growth estimates when determining how much they'll pay. And this compares to the discounted numbers that management teams are comfortable committing to for external purposes. And it's most acute with the higher growth companies because they have the need to discount the numbers the most, because any shortfall, relative to the street estimates will have an outsized negative impact on the stock once public. And again, it impacts the higher growth companies more. In terms of what investors place the most value on, it's not something that I would say stays constant. If you went back to 2014, it was growth at all costs. And it didn't matter how much money a company was losing, and there was little consideration to a particular path to profitability. It was just all about growth. Then things changed dramatically and in fairly short order during the 15 and 16 time frame. And the pendulum swung all the way to the point that investors were saying they only wanted to see companies that were cash flow positive, or would be a quarter or two post the IPO. And, this is essentially when the tech IPO market was shut down for a couple of quarters. And if you look at where things stand now, the pendulum's more back towards the middle. And if anything, I would say even more towards the growth end. Investors still place the highest premium on growth, and they're accepting of losses so long as the cash flow break even is somewhere within 1 to 2 years. And I would say the length of the rope to the cash flow break even is really determined based on the strength of the growth profile. So the higher the growth profile, the longer, investors will give companies, how clear the customer economics are, and the power of those economics, as well as the scalability of the business model. There's a fairly high R squared simply comparing revenue growth to revenue multiples. The higher the revenue growth, the higher the revenue multiple. However, an even higher R squared with recent data points is correlating revenue multiples against a combination of a company's revenue growth and their operating margin, which again shows that investors are focused, not just on growth, but also, what is the efficiency of that growth. So if we, transition now to talk a bit about the current market environment, and I would say, the first comment is the slide was actually created prior to the large drop in the Dow last week, and some of the volatility this week, which, things can change fast, but, I'd say with that said, the market dynamics entering this year were quite favorable. The corporate profits and the market, have generally been strong. We've seen strong results on balance so far, thus far in the earnings season, to the degree companies have reported. And I would say that, the expectations are still that strong fundamentals will continue through 18. Spurred in part, I would say, by the tax reform, that'll provide corporations with greater capital, which, they can use to fund M&A, as well as share repurchases, both of which are good for the market. I'd say recently, with the volatility, obviously there's been, some recent fears, inflation could pick up. What's that going to mean relative to the rise in interest rates, if that happens faster. But, part of it is the market was getting a bit frothy. So, it can be constructive to have a bit of a pullback in the market. It's been good to see stability the last couple of days. And I would say, we're still well above where we were at a year ago. From a market perspective, the multiples are still quite healthy. Clearly, to the degree, there's any more of a pullback, it's something that bears monitoring. But I would say, even though there's been a pullback in the market, again, the multiples are still strong. Fundamentals are strong. And I think the most important thing for, new issues is more that there's stability in the market, compared to volatility. It's a lot harder, for companies to go out if investors are worried about is the market going up or down 1,000 points a day. So, again, even with a pullback, if there's stability in the market, I think there is a lot of activity levels in the IPO pipeline. And I would say, even from what we see, there's a lot of companies that are starting to step up and think about the back half of this year. They're starting to already plan for 2019 as well from an IPO perspective. And then behind that, I would say, the private fundraising market, has remained strong and continues to be a significant amount of available capital looking for a home. You recently had Sequoia targeting, record fundraise. Others are looking at, how do they compete with SoftBank, having a $100 million fund to put to play. The M&A market has remained quite robust, even prior to repatriation, which is why, many of the companies that we see go down an IPO path, at the same time are running a dual process to some degree. Some are more aggressive in running that process, but I think everybody is open, to seeing, what is the best path to monetization and long-term equity value for the company. The convert market has continued to be robust. We see a lot of companies looking to push ahead fairly quickly in this area because they would like to lock in cheap capital, before rates start to march up, which is largely expected. And I would say from a themes perspective, investors are always looking to, focus on major themes. And I would say at least in the tech space, those big trends, that they're looking to invest include, cloud software and infrastructure, AR, VR, cryptocurrency, autonomous, as well as companies with internet-based business models that are disrupting, companies in traditional industries. It's not that, companies can still be outside of these major themes and still be very successful, when there's a compelling market opportunity and company story. It's just that it's always easier to try to tie a story to other major themes that investors are focused on and where they're making money.
Tim, one thing I want to ask you. You made an interesting comment about valuations and volatility, and I wanted to follow up on that point you made, which is valuation ranges are still, fairly, I'd say, fairly high relative to kind of norm, or in the upper quadrant of, if you look at priced earnings, cash flow, EV to sales multiples, they're not, we're not bottoming out like it's a 2002 or 2009 type of valuation. But the volatility piece, what happens if you're a company and let's say you're contemplating filing, or maybe you're in a confidential filing state when you see this volatility? Do you delay? Do you sort of keep forging ahead, hoping for sort of calmer seas? I mean, how do you manage that, or how does a board or directors or management team think about this kind of volatility type of environment?
Sure. So I mean, I would say part of that it can differ. It can differ depending on where a company is at. For like companies that we're talking to that are thinking about like a second half 2018 IPO, do they want to look at what needs to be done for like a first half 19 IPO? For companies in that situation, the recent volatility is somewhat meaningless because, particularly with confidential files, you need to start a banking selection process. You need to go through the SEC registration process. There's a lot of work that can go anywhere from 4 to 6 months that goes into this. And with the confidential filing, outside of taking management bandwidth to focus on the process, with a confidential filing, nobody really knows on the outside world where you're at in the process. So there's still a lot of heavy lifting that needs to be done. And I think most companies want to get through that as quickly as they can so that they have the optionality for when they're going to go out. So we have clients who know that they want to go out. They don't know is it second half of 18, is it the first half of 19, but they're racing full steam ahead, in the months coming to start things up because they at least want to have the optionality on when to go out. Now, if you are already on confidential file and you're well through kind of the registration process with the SEC in terms of working through their comments, and you're thinking about when do we hit the road, I think to me that's when the recent volatility, has the biggest impact. Where typically after you would have volatility like you've seen in the last week, I mean, for most companies that would go out, they would, probably want to see a couple of weeks of stability before going out because you don't want to be on the road. And when you're looking to price your IPO, you have 3 consecutive days when the market does what it did the other day. And so I think you need the stability to go out. I think the other thing is when the volatility levels are higher and investors have a lower appetite for risk, I would say the type of company that would choose to go out and that can go out successfully, can change. When the market is hot and it's open, you can have companies that are more on the bubble and on the fringe of, should they be going out at a certain point in time. When the market is hot, they can get out. When you have more volatility in the marketplace, sometimes the companies that are on the fringe of how attractive they'll be for investors, based on their financial profile or other dynamics, would probably tend to pull back and wait for a more robust market environment.
What do you do with a company that maybe in the last 3 or 4 years took advantage of, say, the abundance of capital in the private marketplace, whether it's VC firms or public mutual funds doing crossover investments into private funds, where they were given valuations that were above sort of the normal range of public market companies, and you end up with an IPO that and we've seen this probably with a dozen companies I can think off the top of my head, where the IPO price is actually a down round to the last private fundraising event. What goes through the mind of the board and management team in those situations, and how do you advise them to sort of, should you do it, should you not do it, should you wait till you grow into your multiple? What do you do in that scenario?
Yeah, sure. So there has been, to your point, more companies that have gone out and they've either had down rounds or equivalent rounds or a very modest up round. I mean, the interesting thing is when we've spoken to investors, and we went back, and I think it was the fall of 2016, when the market did change a lot in terms of the heightened focus on profitability and companies weren't going to be close to their last round. I was pretty surprised that the number, I mean, almost unanimous public investors said, I don't care if the IPO is a down round. And we actually spoke to some investors that were private investors in companies, but they cross over. And they were actually encouraging some of their portfolio companies to go out and do rounds that were, below the last private round, because they were confident that if the company was executing against the growth initiatives, that yes, they would take some dilution on the IPO, but they saw that it was going to start the process of, the stock price performing and getting liquidity, down the road, and they were confident in the business. I would say the biggest considerations for the company, because again, the public company investors don't care. So then it's what is right for, the company to do. And to me, I mean, some of it needs to be case by case. To a degree, it matters. Do companies have, ratchets that are involved where the dilution can be significant? And, part of the way that they obtained the valuations that they did was by putting in, preferred terms, that can lead to substantial dilution. And so I think companies need to be careful around that level. Hopefully most companies learned from some of the others and don't have those types of terms in there, even when they got higher valuations. To a degree, to be honest, when we talk to companies, sometimes it can come down to like just ego in terms of like, I'm not doing a down round, even if it could be, the best and most rational thing for the company to do. There can be considerations of, companies need to be ready from a press perspective, in terms of all the stories that be printed, in terms of, the press that could have previously been on your side, all positive articles. Once the actual financials get out there, the valuation gets out there, they can start to write negative articles about the fact that, the company is being forced to sell stock at a lot lower value. But I mean, to be honest, even on that side, that is pretty short-lived. It's right around the time of the IPO, and more often than not, the companies that have done down rounds on the IPO, they've actually performed well in the public markets, and then that ultimately becomes the story. But it's certainly something that I think companies would need to look at if they can look at with candor that they've received a valuation on a round that just doesn't tie to kind of public company valuations at some point in time. So I'd look most at is going public the right thing for the business.
Yeah, no, that's good advice. I appreciate it.
Sure. So if we start to jump ahead, looking more at the communications aspect of it, at the end of the day, a majority of the equity value in the public markets is going to be driven by a company's financial performance. That could drive 60% to as much as 80% of the value for a company, but it's not 100%. The other 20%, some would argue 40%, is going to come down to how well, a company performs from a communications perspective. So, how effectively do you position the company, the markets you're in, the competitive landscape, the barriers to entry, sustainable advantages, and are you making this positioning clear to the sell-side analysts, the investors, the press and media? Also what type of metrics are you providing, and what areas of the business are you providing guidance on? When we got hired by one of our clients over a decade ago, and it's a very large software company. I had never seen a company that was as large and successful as they were, but they were getting killed on every earnings call, and it came down to the metrics they were providing. In addition to the items they were guiding on. So our initial work with them was streamlining the metrics and the guidance, which is very difficult to do in the public markets, but it was the right thing to do, long term, and the stock performed was significantly better as, the changes were implemented in their communications improved. And, these decisions on metrics really start during the IPO process, as well as setting up, how effectively does a company manage expectations? Because if you take out the internet bubble where stocks traded based on, just press releases and, telling the world you were going to do a stock split, stock performance is really driven by meeting, beating, and raising estimates. And it may not seem right, but the reality is if you delivered $100 million in revenue, the value of your company could be very different depending on whether you initially told the street you would deliver 90 million, 100 or 110 million, because the quality of that performance would be viewed very differently. And assuming if one agrees that, communications can have an impact, let's drill down, further. And I would say, unless a company has, kind of the financial profile of, an Atlassian, ServiceNow, and you're simply going to be taking orders on the IPO, there's things you can be doing in the year or two, leading up to starting a process that'll improve your chances for success. And I'd say, for example, with data and analysis, you can look at who are the top investors in your space, who are the investors that buy similar IPOs, who are the ones that hold on to the stock and build positions post the IPO compared to those that sell out shortly afterwards. Then the goal is to go out and proactively establish relationships with them, before you meet them for the first time during the IPO. When we surveyed, top investors, they've told us they would like to meet companies 3 or 4 times before making an investment in an IPO, because this is what helps investors, get to know companies better, gain confidence in the management teams as they see a pattern of execution and delivering on what you say you're going to do. So we have clients that set up non-deal roadshows several quarters leading up to the time they pick bankers. And it's really important when you do this, not to just let the banks take you who they want to get you in front of. You really want to take ownership of that process so you're getting in front of the funds that are in your best interest. There was a high-profile, vertical SaaS company where we worked the investment bankers hard to get the right day in Boston and the Midwest to make sure the company was building relationships with the right investors. And, the difference was the schedule actually changed by over 50% versus if we just let the bankers control, the process, because they can have a dual interest if it's just left in their hands. And, another case, one of our clients that went public that got acquired was Cvent, and they were probably one of the most aggressive companies on hitting the road between picking bankers and filing for the IPO. And they did this partly because they needed to make up for some time that was missed previously, building the type of relationships I just discussed. And again, they probably met with more investors, during the registration process than anybody we worked with, and it worked out great, for them because, the investors that they met with on the actual IPO roadshow converted to orders in, mid 90% of the time, which is a best-in-class, conversion rate. And the thing is if you have time to plan in advance, it's in the company's best interest, to start to get out and tell the story. There's, probably 100 plus, conferences just in the technology sector, to choose from. And you got to be smart about how you use your time. And because even some of the, highly reputable investment banking firms, you can fly across the country and do a presentation, and there's only 10 people in the room, and 8 of them are from the banking firm. And you wind up with one-on-ones that are private equity and VC funds trying to put money into your company or doing research on the rest of their portfolio compared to public company investors you're trying to start building relationships with. So you just need to be thoughtful about which conferences you're going to, kind of being aggressive about managing how you're spending time. For most companies, you really want to start establishing relationships with the sell side early in the process. I would always say at least a year in advance of an IPO, so they can start to learn the company better. You can get a feel as to whether or not they're really interested in the company. And, are they writing about you in their theme pieces? You don't want to find out, I would say, during the IPO process itself that you have a bank on the cover where the analyst isn't really a fan of the company. And we find this, with some of our clients where we get involved later, and the company didn't put in kind of the rigor that they should have, in terms of interviewing the sell side, during the process. So, there's a lot of benefits to getting started early, in the game from an IR perspective, but there's also, challenges, and companies can do more harm, than good if they're not prepared. Companies, are often not ready for meetings with the buy side because they don't have an effective, investor deck that's tuned for investors, or they're not ready for the types of questions they'll be asked, and can have a false sense of security because they've, a lot of times have, conducted meetings with VCs to raise money, but these are just different, types of meetings. And so, we receive feedback from the buy side, like, I'm glad you brought so-and-so through, they weren't ready. Companies that have, or funds that have passed on, even seeing companies during the IPO roadshow because of not being pleased with the meetings during the private companies or the private company tracks that they had, previously. And the other thing is, be careful about what you're sharing, from a financial and metric perspective during these meetings, because I can guarantee you the buy side is writing down everything, that you would be saying during these meetings, even the sell side analysts, and they're going to be bringing up later down the road.
Yeah, it's an interesting point you bring up, Tim, for public companies in terms of the amount of metrics you want to provide. And it's, everybody wants transparency and you give as many metrics as you can, but how often do those metrics disclosed early in the cycle come back to bite you when you're public? Is that have you seen that happen, down the road in your experience?
Yeah, and it comes down to how well the companies manage the disclosure process, because I would say that companies share more with like the bankers than they will the analysts, and they share more with the analysts during the IPO process than they will afterwards. And it's necessary because companies aren't known and they don't have a track record to rely on. And so, it's important for companies when they are showing more leg than they will post the IPO to be extraordinarily clear what is extra, what they will never get again, and what they are never to ask on a public company conference call or show up in any written research. And the analysts that have been involved in these processes kind of know the drill, but it still requires the management teams to be all over, managing that information flow carefully.
Yeah, that makes sense.
And it kind of ties, exactly to the next slide here in terms of, after banker selection, which I would say, is a separate kind of talk track about selecting the team, kind of how to put it together and negotiating, economics. But, you'll be moving into preparing for the org meeting and the analyst meeting. And this is exactly where, you're managing, the type of information that we were just talking about, Jason, where, with like one of our, software companies in the healthcare space where, we debated and, ultimately won, with Goldman and Deutsche on, showing pipeline information, bookings info, sales productivity measures to kind of support the type of model that was being shown to the analysts pre-IPO. And, they knew it would never be shared again. And, if we didn't do this, all of the analysts were like, this is incredibly helpful, because they wouldn't have had any confidence in the projections if we weren't willing to show some of that extra context in the meeting. And I would say, how these meetings are handled with the research analysts are, critical. It impacts how big of a haircut are the analysts going to put on the numbers, how aggressive will they be, supporting the company when they do calls with the buy side during the roadshow. And I know going back to when I was an analyst, it made a huge difference, how well the company presented during these stages, as well as how were they doing in terms of managing expectations. So, if there's a quarter or two during the IPO process, looking at were these solid beat and raise type quarters, or, were they sloppy if they were public? Did the revenues come in, only 50K light? But if they came in 50K light during the private company stage, I'm worried about, are they going to come in 5 million light when they're a public company? And, part of this relates to what type of model is being shown. We have seen companies that show literally their plan to the analysts during this stage. Others have major discounts to the point where the model doesn't look attractive. I mean, at the end of the day, you need to have a model that supports the fundamental story that's being prepared and presented, but you also need to have the right amount of cushion to beat and raise numbers. Because if you don't beat and raise numbers as a public company, the bottom line is you're not going to be successful. So you need to think about, like today, what do I want to be showing to analysts if I know these numbers ideally would be raised anywhere from 6 to 8 times before the number was finally delivered for the out year. And you also need to be thinking about what type of color you need to be able to provide to show the degrees of conservatism that have been built into the model. I would say some of the other things to be thinking about during this process is, as you're closing out the 1 to 2 quarters before you hit the road, you should be, thinking about from a communications perspective to, host a mock earnings call with your syndicate analysts. So get used to how you're going to be doing this as a public company while you're still private, in terms of putting together a press release, scripting up the CEO and CFO, preparing for the Q&A that you would have, and then kind of the end result coming out is, once you go through the model, you update the analysts in terms of the most recent, financials. It is essential to follow up aggressively in gathering their models, looking at every line item, every quarter, every year to make sure that they're in line with where you want the models to be. And I would say one of the highest profile software companies in the world who basically beat expectations by 5 to 10% every year until they were, $1 billion in revs and beyond. The one time that they didn't manage expectations and it hurt them bad was during the IPO process. And it wasn't that they didn't initially set a conservative bar for the IPO, but they had a big quarter before they went out and marketed the deal after they had already provided the analysts with views on the financials. And the challenge was they didn't go out and do a thorough job of gathering, version 2 of the models. So they actually went out and marketed the deal. The analysts did with numbers that were higher than where the company was going to provide their initial guidance. And you might imagine that did not send the stock up when they provided guidance. In fact, their stock dropped 20 to 25% the first time they provided guidance as a public company. And it wasn't that the guidance wasn't strong. It's that they weren't on top of where were the analysts actually marketing the deal, which is why, again, it's an essential part of the process. Another area where IR can add a lot of value, I would say, to what the bankers are doing is in the area of the roadshow prep. From working on 100 plus of these. Oftentimes we find companies spend way too much time on the slide creation, formatting slides, small tweaks to slides, moving them around. There's literally version 50, 75 of decks during the IPO process. And candidly, a lot of these changes will make little difference in terms of whether or not you're going to be successful. Some of the slides I would say, though, that are important relate to the market. It's an area that challenges a lot of private companies, so I would strongly suggest you start thinking about, the market, even before you pick bankers and start the process, because you need to be able to describe the size of the opportunity. And this can sometimes mean hiring a third party to do some work for you. The biggest drawback, I would say, in terms of the over-focus on slides is it can take away from what are you actually saying on the slides? Are the key messages being delivered? Are you ready for Q&A in terms of handling the different questions that could be forward-looking? Are you hitting the key messages in those? Because if you're doing the job effectively with telling the story with the slides, in addition to the roadshow video, pretty much 100% of your IPO meetings is going to be Q&A, and you're not going to actually flip slides. And so it's essential to be ready, for all of the different permutations of questions that you could get during the roadshow. And, that's why, at least on our end, we spend a lot of our time focused on the Q&A prep, because I think it makes the biggest difference for how well prepared companies are. And then the last thing I would say in terms of, this phase is, companies need to be prepared in terms of pushing the banks rather than just taking the recommendations in terms of like top 15, 20 allocations in terms of how the stock would ultimately get placed. Because you want to make sure that you have the right holders for you, that you're not, taking in, fast money hedge funds that might be getting paid back by the banks because they helped them out on another deal, or that they simply pay large fees to the banks. And so really understanding the types of backgrounds of the funds and pushing the banks for why is Fund X getting recommended for an allocation Y, and having insights on that is important because most of the stock gets allocated to the top 15 to 20 at the end of the day. Moving on to the other side from the IR piece, closely integrated is on the PR and financial PR, where I'd say the spotlight on IPOs today is a lot brighter than years ago. There's national media, bloggers, IPO analysts, commentators, providing their views on the company, and even with confidential filings, the public whispering begins early on with many IPOs. And as soon as the roadshow begins, the management team's online, with the retail roadshow for everybody to see, in terms of employees, customers, business partners, they're all more aware and more engaged in this process than ever before. So it's really critical to manage, the PR process with care and diligence. And while companies in the IPO quiet period are limited in what they can say or do, it doesn't eliminate the ability to engage with the media and others, to limit errors and misrepresentations, to educate employees and other stakeholders about the process, or to, react to developments that occur. The other thing is IPOs are a very important branding opportunity for companies. And, even with the quiet period rules, there's an opportunity to secure and participate in media coverage around the IPO. You just need to be well prepared, for who you're talking to, what they're going to ask, how to respond, what to avoid. And I would say, one of the things that I find a lot, when I talk to private companies is they wait too long to start thinking about like corporate and financial PR, where, they decide a month before they're going to start an IPO process that the world doesn't know who they are. And they want to go out and start an aggressive, corporate PR campaign. And by that time, it starts to become too late because they're on the cusp of going into the IPO quiet period. And so I would really encourage companies to start thinking about that, a minimum of 12 months in advance of the potential IPO process. So during the IPO phase itself, prior to starting the IPO phase, it's important to be thinking about life after the IPO. There's several key areas that, I would always recommend starting to think about. First and foremost can be on the guidance, front, what do your peers provide? What's the visibility in your business? How does the company typically perform relative to plan? Are you comfortable with quarterly or just annual or both? You can always leave it to the street and not provide guidance, but if you do that, you're basically letting investors dictate the expectations as compared to you taking control of the expectations yourself when you know your business better than anybody else from a Wall Street perspective ever will. Thinking through early, what are the metrics you want to be measured against? What do the peers provide? What's the volatility in your metrics? And what type of frequency would you be comfortable, sharing metrics? Again, just quarterly, annually? Will you be precise in the metrics, or will they be kind of milestone based? Thinking through what your quiet period should be, and you need to make sure that you set this before you actually go public, and you have to stick to it. I'd say when I was an analyst, I could almost always tell how things were going, from talking to the CEO or CFO, even if I never once mentioned the quarter. I remember years ago we had a new client that believed they knew what they were doing because they ran big public companies in the past, so they were happy to host investors during the quiet period because they would say, we're not telling them anything different. And I almost died in the first one I sat in. It was prior to us officially getting hired. And a sell-side analyst told me afterwards that every analyst that talks to them knows exactly what's happening just from the meetings they do with the company. So it was something that we changed pretty quickly after getting engaged. And I would say that, from a, quarter prep perspective, I'd say a lot of times I hear from companies when they're private that, after the first call out as a public company, everything should be pretty smooth sailing and easy after that. And, I guess I would say that would be true if your positioning and strategy never evolved, if there were, no market or competitive changes, and if you beat and raised numbers every single quarter for your entire history. But companies need to appreciate that these are the 4 biggest events that impact your personal credibility, as well as the market value of the stock each and every year. So, how well companies do is not just a function of the results. It's significantly impacted, I would say, by the level of focus and process that's put in for, how effective they manage the 3 to 5 week cycle after the quarter is over and before you report. Because if you're, the type that likes to wing it or put things last minute, those are the companies I would say that struggle the most, because most of the time they end up getting hurt during the QA portion of the call, or they, put something in the remarks that wasn't as well thought out as they should have. And it's something that can stick with them. If you don't execute well on an earnings call, it's something that can stick with you, for the next 2 to 4 quarters. Another key area to be thinking about in advance of the IPO is just the ongoing commitment the company has to building, educating and nurturing an audience for the company. Sell-side analysts are publishing reports that impact your brand. So you need to make sure that you're engaging with them properly, so they're educated and effective in their jobs when they're talking to the investment community. From an investor perspective, you need to make sure that you're focused on trying to maintain and expand the existing shareholders. At the same time, you're always prospecting. And they may not all buy right away. It could take 6 months, 12 months, or even longer. But I would say don't fall into the trap of, hey, I met with them and they didn't buy. I don't want to waste my time again. Because there's going to be liquidity events, such as the IPO lockup expiration, a follow-on offering, or just dislocation in the market. And you want to make sure you put in the time so that when there is that type of demand or supply, that you've got the demand to offset that. And I would also, it's important to remain focused on building and nurturing the relationships with the relevant business media, financial journalists, because they're shaping the company's perception on a broader scale that reaches not just investors, but customers and partners. I would say where we would see companies sometimes falling short in this area is just underestimating the time commitment that is required in this area, or if it's shallow or infrequent communications with investors. Ultimately there's going to come a time when a company runs into a difficult situation, and when that happens, you won't be given the benefit of the doubt, or there could be a lack of buyers to step up, and it can just lead to excess volatility. And from the media perspective, if you're not continuing to invest post IPO in the corporate and financial PR, effectively when you go public, you have a new product, which is the company that you need to market. And so I would just kind of keep that perspective in mind. It kind of ties in with the if 20 to 40% of the company's value is determined based on the failure or success of the financial communications program. When we look at the companies that don't perform well, taking just business performance off the table, I would say there's a number of factors that we look at in terms of what's the most kind of common denominator. And I would say failing to manage expectations effectively. Slow and steady is going to win the race, particularly coming out of the gate initially. It's pretty stunning how many companies stub their toe in the first couple of quarters, post IPO. And when you do that, you're in the penalty box, for at least a year. And that assumes kind of perfect execution after that. I'd say another factor is, stretching the positioning of the company at the time of the IPO, to try to maximize, value instead of, being more candid about what's the reality of the company's business and the opportunity, which often, catches up with companies ultimately. I'd say, post-IPO communications around M&A in terms of, how deals get positioned, explaining, the type of dilution and transparency on results after the acquisition. I would say consistency of messaging is another thing that is critical. A lot of times we can hear clients where the initial reaction of the CEO is, I don't want to go through this again. I've already talked about this before. I just said this last call. but it makes a big difference in terms of how educated the investment community is going to be because they're covering hundreds of companies. So making sure they understand, your business. I would say planning around the lockup, kind of ties to what I was talking about earlier in terms of, being thoughtful about when supply is going to be coming to the market, but also leveraging that if you can. If there's going to be follow-on offerings to, are you going to expand the syndicate beyond what you had from the IPO to include more institutional support, more banks to support you on that moving forward? One of the others that I would point out is, a lot of times we see, situations where, board members may not be, entirely in the know on what's going on from an IR perspective on the ground. And sometimes you can have board members where they are extremely impressive and knowledgeable from an industry perspective, but they may not be as sophisticated from, a capital markets and how to manage the street perspective. And I mean, I literally ran into this, the other week where, my jaw hit the ground with how low the board wanted to encourage the company to guide, for the, 2018 timeframe just to set up beat and raise, even though it ran very contra to how the company had already been talking about the business, and it was entirely unnecessary to try to set up the beat raise in the way that was being suggested, by the board of directors. And, it's just that they weren't sophisticated in this area. So I think it's very important to make sure that board members are kind of in touch with the IR program, early on, and that they're educated, and it's, there's good communications between, the board members' knowledge and the IR, from an ongoing perspective. I'll go through a couple of quick examples of, companies that have, done it well, areas where we've seen issues, in the past. I look at, managing expectations. We talked about some, but, a company like Guidewire, when they went public, they could have easily called themselves a 30+% grower. The growth was strong, but there were some complexities in the financial model and they wanted to be conservative. So, they committed to being a 20% grower. They were very understated, under-promised, over-delivered. The stock was a home run post-IPO, completed a few follow-on offerings for hundreds of millions of dollars. The stock went from the teens at the IPO to over 75 today. On the flip side, we had a client where, it was an SMB marketing company, and they had a couple of successful years, but when they started to face more headwinds, they were in the mode of basically death by 1,000 cuts. They never wanted to, bring the bar down to the right level. And sometimes the guidance, could even have a high end that was above the internal view of the company. They'd find themselves in a trap of, talking on, their earnings call about how good of the first month of the quarter was, which, really is a no-no, but it was something where they just continued to face challenges, in their communications because every step forward ended up being two steps back. I would say that, we talked, a bit about the metrics, and I would say, stretching the positioning of the company. I mean, we had a client where they basically a software company where they didn't want to talk about the services angle of the business, but when the recession came around, back in the 09 timeframe, they basically couldn't predict the services angle of the business. And when the street really started to realize what they were, they basically traded at a discount to other companies in the space on a perpetual basis going forward, even when their growth was superior to others and the margin profile was superior. So it's something where you always want to make sure that you're telling the right story, about the company to the street. I guess I'll skip over the other metrics, given the time. And I guess the last place where I'll talk about is we often get asked by private companies whether they should hire internal, go external, or if they should have both. From my perspective, at least, an internal hire is needed if you're, going to be a company that has a significant profile in the marketplace right from day one. So a very high profile company where just the sheer volume of the IR activity is going to be enormous. But to provide some perspective, like in our business, our kind of external full IR outsource clients are about $1 billion of market cap on average. It scales up to about $3 to $4 billion. They have about 10 analysts, whereas the companies that have internal are typically multi-billion-dollar companies, right from the start, with an expectation you'll have kind of 15 plus analysts. I would say that the external model is lower cost. You can also get the leverage of the senior level capital markets experience and the sector expertise that can sometimes be hard to afford internally. Kind of the best of both worlds is to have the hybrid, where you get the benefit of the dedicated professional internal, but you also have kind of that external expertise, just as you would from a legal or an accounting perspective, and considering that, this is an area that can impact, valuation of company by hundreds, of millions, billions of dollars. It's an area that, sometimes can be overlooked by companies, but, the ROI can be significant. So that was, kind of, again, the summary would just be, I would start thinking early about, the strategic importance of the communications. And, the CEO Snap, I think said it well when he said, one of the things I underestimated was how much more important the communications would become as a public company.
No, Tim, I think this is great. I think that if I had to sum up one thing that I even learned from this presentation was just how all-encompassing and prepared you have to be before, during, and after that process, and that it's an ongoing journey, and it's, as your business changes, your communication strategy changes, and how you have to manage the street. So I think it's great advice and detail for everyone on the call, and I really appreciate you taking the time. I know we hit the top of the hour. So we're probably running a little bit out of time, but I just wanted to say thank you very much, and everybody on the line, thank you. If you have questions, you can shoot them in to us here at NetSuite, and we'll circle them over to Tim and get back to you. And we appreciate everybody's time today. So, Tim, thank you very much, and everybody have a great day.
Okay. Thanks, Jim.